Hi everyone. Welcome to the last part of interpretation of gross profit and operating profit margin. So in this particular video, I'm going to teach you how you have to interpret gross profit margin and operating profit margin when you're comparing the performance of a company with that of its industry average. So I'm just going to quickly go through this particular question, December 2012. And I've already told you my focus is on teaching you how to interpret rather than on how to find the calculations. Because if you have been watching my previous videos, you already know that calculation is not that important. But some students get confused. They think a lot of on calculation. Calculation you will be getting only 5 or 6 mark. For each ratio, you will get 1 mark. So if it is they are asking you 5 ratios, you'll be hardly getting 5 marks. And when you write when you calculate ratios, you just normally calculate and show the calculation what is there in your numerator and what is there in the denominator. Even if you make some mistake, even if you don't add, even if you don't minus, even if you don't adjust, don't worry. You're only going to lose half mark provided you show the calculations. And even if your calculations are wrong, if your interpretations are correct, you will get the entire marks for interpretation. So forget about calculations, focus more on interpretation. So how do you interpret gross profit margin and operating margin? Pretty simple. Let's learn it again. So gross profit margin of quartile is 25%, whereas of sector it is 35%. So quartile is performing below its sector and write the percentage of underperformance. So quartile is performing 10% lower than the sector. But don't write it as 10% because it will be 10 divided by compared to the industry average. Take 35 as your, take the sector average as your base. So 10 divided by 35%, quartile is performing 28.5% lower than the sector. Now, why is it underperforming? So when will gross profit fall? Gross profit margin will fall when gross profit is lower or when revenue is higher. But if you have been watching my class, this is not your answer. Don't write revenue is higher, just write gross profit is lower. Why gross profit is lower? So is there anything in this scenario to suggest why gross profit is lower? No, quickly read this. Cotail sells jewelry through stores in retail shopping centers throughout the country. Over the last 2 years, it has experienced declining profitability and is wondering if this is related to the sector as a whole. It has recently subscribed to an agency that produces average ratios across many business, and they've given all this sector average. And you have to calculate this. I've already calculated for you. So there is nothing, no informations. If you attended my first video, when we comparing ratios, operating margin and gross profit margin with two companies, they will provide you figures of the second company as well. But when there is sector average, they don't give you any informations apart from the averages. So we cannot really say that revenue of the sector may be higher, whereas quartile is lower, etc. Then how we are going to interpret gross profit margin when comparing which sector? Let's learn that. Gross profit margin of quartile is 25%, much lower compared to the sector average of 35. Here, 25 and 35. A possible explanation, yes, when it is sector average, one, remember that. I have already explained this particular item in gross profit margin, how to interpret gross profit margin in my first video when I taught you how to interpret when you are comparing with another company. Same point. It is possible that Cotel is deliberately charging a lower markup in order to increase its sales by undercutting the market. The same language, the same point which I have discussed in my part 1 video when I taught you how to interpret gross profit margin when we are comparing performance of a company with another one. The same language, the same word, same concept. Now we have to prove they are doing like that. So to prove that, if you see this average inventory turnover, it shows how many times. Sector is only 3 times. Cotail, it is 4.5. So what is inventory turnover? Inventory turnover tells how fast are you converting your inventory into sale. So in other words, Cotail inventory turnover ratio is much higher than the sector. That means Cotail is able to sell more. That means Cotail is able to sell more means Cotail is having more revenue as compared to sector, but their gross profit margin is lower. The same scenario which we have come across in my part 1 video of gross profit margin. Same thing. So revenue. So remember this. Even if you have not watched that part 1 video, remember this. No matter what the situation, no matter when you're comparing with previous year, no matter when you're comparing with industry average, no matter if you're comparing with another company, whether there is an acquisition, whether there is a disposal of subsidiary, all those 5 types of questions they will ask you in your ratio analysis or interpretation of financial statement. No matter if the revenue is higher but your gross profit margin is lower in this case, then you write this point. It means that they have a marketing policy where they are selling more products at lower price. That means they are reducing their selling price so they can sell more. So when you reduce your selling price, people will buy more. So your revenue will go up. But that doesn't mean you get profit because you're selling at lower price. So it means they are deliberately charging a lower selling price in order to increase their sale. And we have proved their inventory turnover is 4.5. That means they are able to sell much quicker than average, industry average, but their profit is lower. We have proved it. You have to prove. So writing this will fetch you 1 mark and proving this will fetch you another 1 mark. As simple as that. Now let's look into operating profit margin. So what is happening to the operating profit margin? If you see this operating profit margin of Cotail is 7.5, whereas sector average is 12%. So when will operating margin falls? That means Cotail is underperforming sector. So operating margin will fall when the numerator operating profit is lower or when the denominator revenue is higher. As I told you, we won't focus on revenue, focus on operating margin, why it is falling. If you have watched the last 2 videos related to gross profit margin, you know that. Remember, once again, we are in our last part. So remember, whatever types of question you're facing, whether it is comparing with previous year, whether it is comparing with industry average, whether it is comparing two companies, whether there has been acquisition of a subsidiary, whether there has been a disposal of a subsidiary. If your gross profit margin is lower, it will feed to your operating margin. Cotail's low gross profit percentage has fed through to contribute a lower operating margin. It's always a standard answer. Remember that point. Now, we can also say that I told you in the last 2 videos, when you are comparing operating profit margin, you write 2 points. One, the higher gross profit is resulting in higher operating margin, or the lower gross profit is resulting in lower operating margin. That is of 1 point. Second point, if you have watched my other 2 videos, how to interpret gross profit and operating margin, I explicitly told you one thing. Operating margin, you take administration and distribution expense and compare. So I've shown how you have to compare in my part 1 video when I taught you how you have to interpret operating margin when you're comparing performance of a company with that of another organization. But you don't have such figures. It is sector average. So how do we do that? Because in sector average, they won't give you figures, revenue, opening inventory, etc. Then how will you do that? How will you verify if Cotail is able to have better control over its overheads? What you do? Gross profit margin is 25%. Operating profit margin is 7.5. So what is the difference? 17.5. What is that? The difference between gross profit margin and operating profit margin is the indirect expenses. Overhead, selling and distribution expense. Don't bother about finance cost. The sector, it is 35 and 12, that is 23 percentage. So in other words, the indirect expenses or selling and distribution expenses of sector is 23 percentage of revenue. Yes, of revenue. You heard it right, of revenue. Because gross profit margin is gross profit divided by revenue. And operating profit margin is operating profit divided by revenue. So now we are comparing gross profit, difference between gross profit and operating profit. That is nothing but overheads or your indirect expense, selling and distribution expense, overhead. So we are comparing this against revenue. So now the operating expenses, the selling and distribution expenses, the indirect expenses of Cocktail is 17.5% of revenue, whereas of the sector it is 23% of revenue. That means Cocktail's operating cost, I told you this, that it means Cocktail's operating cost of revenue appear to be lower and it appears to be better controlled than sector average. So I've taught you how you have to interpret gross profit and exactly what are the 2 points you have to write when you're interpreting operating profit. One, the gross profit increase or decrease is resulting in increase or decreasing operating profit margin. And the second one, you always compare the operating expenses, the selling and distribution expenses. In certain question, it will be directly given, and certain question, it will be like this, which I taught you. So it may also indicate Cocktail has a different classification of cost between cost of sales and operating cost. Yes, it can happen because the sector certain expenses will go to cost of sales and they might have. So even if you write this, perfect. Or maybe Cocktail may be spending on, or maybe the sector may be spending on advertising or selling companies or whatever. You can write whatever points you want. So remember this point, the gross profit point, and this particular point. Now let's practice one more question on how to interpret operating profit and gross profit when they are asking you to compare with a sector average. The last question, March June 2016, we are focusing on gross profit margin. Once again, gross profit margin of non-net 17.1 and sector average it is 21%. So non-net is performing much lower than its sector average. So let's go. What is that? Gross profit of non-net is 11.6. It is underperforming by the sector. This may be due to a deliberate policy of underpricing competitors to increase sale. That's it. Now it was a manufacturing company. So we just wrote maybe that may be due to inefficient manufacturing as well. The other one, Cocktail, was a retail sector, so we cannot write that point. Manufacturing company, you simply write maybe inefficient manufacturing of products. So customers are not interested. Now, with respect to operating profit margin, what are we going to do? Operating profit margin is also lower, 7.8 and 10.3. So you're right. The operating profit, the gross profit margin fed through to operating margin reduces. And what we have to do, same thing, which we did, operating expenses, 17.1 and 7.8. What is the difference? Difference between gross profit margin and operating margin are indirect expenses. So indirect expenses of non-net, it is 9.3%, and 21 is the gross profit margin of sector, and whereas operating margin is 10.3, the difference is indirect expense. So the indirect expense as a percentage of non-net is 9.3% of revenue, whereas sector it is 10.7. So non-net is having better control of operating expenses as compared to its sector average. It is as simple as that. Thank you everyone for watching this video. I'm Basil Nilamra, tutor for financial reporting at Kaplan School of Accountancy and Management. If you want to know about my upcoming classes, please follow my Instagram page, Learn with Basil Nilamra. All the best for your upcoming ACCA examination.